Hello friends, so in this series of first unit of understanding international foreign exchange markets under international financial management, we will understand a very important theorem, interest rate parity. Under interest rate parity, both covered and uncovered interest rate parity would be talked about. Interest rate parity is fundamental knowledge for traders of foreign currencies. In order to fully understand the two kinds of interest rate parity, however, the trader must first grasp the basics of forward exchange rates and hedging strategies. So, for that, we will talk about how to hedge the exchange risk using various strategies. So, let us now start with interest rate parity. Interest rate parity refers to the fundamental equation that governs the relationship between interest rates and currency exchange rates. The basic premise of interest rate parity is that hedged returns from investing in different currencies should be the same, regardless of the level of their interest rates. Let us try to understand the basics through an example of diagrammatic representation and its explanation. Example: let us consider investing 1000 euro for 1 year. As shown in the figure on screen, we will have two options as investment cases. In the US, let the spot exchange rate be $1.2245 per 1 euro. So, practically, we get an exchange for our 1000 euro at $1.2245, which gives us $1224.50. We can invest this money, that is $1224.50 at the rate of 3% for 1 year, which yields $1261.79 at the end of the year. Case 2, international investment. We can also invest Euro 1000 in an international market where the rate of interest is 5% for 1 year. So, 1000 euro at 5% for 1 year gives Euro 1051.27. Let the forward exchange rate be $1.20025 per 1 euro. So, we buy forward 1 year in the future exchange rate at $1.20025 per 1 euro, since we need to convert our 1000 euro back to the domestic currency, that is the US dollar. Then we can convert Euro 1051.27 at $1.20025, which gives $1261.79. Thus, when there is no arbitrage, the return on investment is equal in both cases, regardless of the choice of investment method. Arbitrage is the activity of purchasing shares or currency in one financial market and selling it at a premium or a profit in another. Now, we will understand the two versions of interest rate parity. There are two versions of interest rate parity. The first one, covered interest rate parity, and second, uncovered interest rate parity. Let us go on to learn about what determines interest rate parity and how to use it to trade the forex market. Calculating forward rates. Forward exchange rate for currencies refers to exchange rate at a future point in time, as opposed to spot exchange rate, which refers to current rate. An understanding of forward rates is fundamental to interest rate parity, especially as it pertains to arbitrage. The basic equation for calculating forward rates with the US dollar as the base currency is: forward rate is equal to spot rate into 1 plus interest rate of overseas country divided by 1 plus interest rate of domestic country. Forward rates are available from banks and currency dealers for periods ranging from less than a week to as far out as 5 years and beyond. As with spot currency quotations, forwards are quoted with a bid-ask spread. Consider US and Canadian rates as an illustration. Here we are taking currency of two different nations for our convenience, as American dollar and Canadian dollar are easily comparable. Suppose that the spot rate for the Canadian dollar is presently 1 USD is equal to 1.0650 Canadian dollar, ignoring the bid-ask spreads for the moment. 1-year interest rates, that is priced off the zero coupon yield curve, are at 3.15% for the US dollar and 3.64% for the Canadian dollar. Using the above formula, the 1-year forward rate is computed as 1 USD is equal to 1.0650 into bracket 1 plus 3.64% divided by 1 plus 3.15%, which gives us 1.0700 Canadian dollar. The difference between the forward rate and spot rate is known as swap points. In the above example, the swap points amount to 50. If this difference, that is forward rate minus spot rate, is positive, it is known as forward premium. A negative difference is termed a forward discount. A currency with lower interest rates will trade at a forward premium in relation to a currency with a higher interest rate. In the example shown above, the US dollar trades at a forward premium against the Canadian dollar. Conversely, the Canadian dollar trades at a forward discount versus the US dollar. Can forward rates be used to predict future spot rates or interest rates? On both counts, the answer is no. A number of studies have confirmed that forward rates are notoriously poor predictors of future spot rates. Given that forward rates are merely exchange rates adjusted for interest rate differentials, they also have little predictive power in terms of forecasting future interest rates. Covered interest rate parity. According to covered interest rate parity, forward exchange rates should incorporate the difference in interest rate between two countries. Otherwise, an arbitrage opportunity would exist. In other words, there is no interest rate advantage if an investor borrows in a low interest rate currency to invest in a currency offering a higher interest rate. Typically, the investor would take the following steps. Number 1. Borrow an amount in a currency with a lower interest rate. Second, convert the borrowed amount into a currency with a higher interest rate. Third, invest the proceeds in an interest-bearing instrument in this higher interest rate currency. Fourth, simultaneously hedge exchange risk by buying a forward contract to convert the investment proceeds into the first lower interest rate currency. The returns in this case would be the same as those obtained from investing in interest-bearing instruments in the lower interest rate currency. Under the covered interest rate parity condition, the cost of hedging exchange risk negates the higher returns that would accrue from investing in a currency that offers a higher interest rate. Covered interest rate arbitrage. Consider the following example to illustrate covered interest rate parity. Assume that the interest rate for borrowing funds for 1 year period in country A is 3% per annum and that 1 year deposit rate in country B is 5%. Further, assume that the currencies of the two countries are trading at par in the spot market, that is, currency A is equal to currency B. Now, an investor firstly borrows in currency A at 3%, then converts the borrowed amount into currency B at the spot rate. Next, invest this proceeds in a deposit denominated in currency B and paying 5% per annum. The investor can use the 1-year forward rate to eliminate the exchange risk implicit in this transaction, which arises because the investor is now holding currency B but has to repay the funds borrowed in currency A. Under covered interest rate parity, the 1-year forward rate should be approximately equal to 1.0194. That is, currency A is equal to 1.0194 currency B, according to the formula discussed previously. What if the 1-year forward rate is also at parity, that is, currency A is equal to currency B? In this case, the investor in the above scenario could reap risk-less profit of 2%. Here is how it would work. Assume the investor borrows 1 lakh units of currency A at 3% for 1 year period. Immediately converts the borrowed proceeds to currency B at the spot rate. Places the entire amount in a 1-year deposit at 5%. Simultaneously enters into a 1-year forward contract for the purchase of 1,03,000 units currency A. After 1 year, the investor receives 1,05,000 units of currency B, of which 1,03,000 units are used to purchase currency A under the forward contract and repay the borrowed amount, leaving the investor to pocket the balance of 2,000 units of currency B. This transaction is known as covered interest rate arbitrage. Market forces ensure that forward exchange rates are based on the interest rate differential between two currencies. Otherwise, arbitrageurs would step in to take advantage of the opportunity for arbitrage profits. In the above example, the 1-year forward rate would therefore necessarily be close to 1.0194. Okay, so now we will discuss uncovered interest rate parity. Uncovered interest rate parity, also called UIP, states that the difference in interest rates between two countries equals the expected change in exchange rates between those two countries. Theoretically, if the interest rate differential between two countries is 3%, then the currency of the nation with the higher interest rate would be expected to depreciate 3% against the other currency. In reality, however, it is a different story. Since the introduction of floating exchange rates in the early 1970s, currencies of countries with higher interest rates have tended to appreciate rather than depreciate, as the UIP equation states. This well-known conundrum, also termed the forward premium puzzle, has been the subject of several academic research papers. The anomaly may be partly explained by the carry trade, whereby speculators borrow in low interest currencies such as the Japanese yen, sell the borrowed amount and invest the proceeds in the higher yielding currencies and the instruments. The Japanese yen was a favorite target for this activity until mid-2007, with an estimated $1 trillion tied up in the yen carry trade by that year. Relentless selling of the borrowed currency has the effect of weakening it in the foreign exchange markets. From the beginning of 2005 to mid-2007, the Japanese yen depreciated almost 21% against the US dollar. The Bank of Japan's target rate over that period ranged from 0 to 0.50%. If the UIP theory had held, the yen should have appreciated against the US dollar on the basis of Japan's lower interest rates alone. The interest rate parity relationship between the US and Canada. Let us examine the historical relationship between the interest rates and exchange rates for the US and Canada. The world's largest trading partners, the Canadian dollar has been exceptionally volatile since the year 2000. After reaching a record low of US dollar 1.79 in January 2002, it rebounded close to 80% in the following years, reaching a modern day high of more than US dollar 1.10 in November 2007. Looking at long-term cycles, the Canadian dollar depreciated against the US dollar from 1980 to 1985. It appreciated against the US dollar from 1986 to 1991 and commenced a lengthy slide in 1992, culminating in its January 2002 record low. From that low, it then appreciated steadily against the US dollar for the next 5.5 years. For the sake of simplicity, we use prime rates, the rates charged by commercial banks to their best customers, to test the UIP condition between the US dollar and Canadian dollar from 1988 to 2008. Based on prime rates, UIP held during some point of this period, but did not hold at others as shown in the following example. The Canadian prime rate was higher than the US prime rate from September 1988 to March 1993. During most of this period, the Canadian dollar appreciated against its US counterpart, which is contrary to the UIP relationship. The Canadian prime rate was lower than the US prime rate for most of the time from mid-1995 to beginning of 2002. As a result, the Canadian dollar traded at a forward premium to the US dollar for much of this period. However, the Canadian dollar depreciated 15% against the US dollar, implying that UIP did not hold during this period as well. The UIP condition held for most of the period from 2002, when the Canadian dollar commenced its commodity-fueled rally, until late 2007, when it reached its peak. The Canadian prime rate was generally below the US prime rate for much of this period, except for an 18-month span from October 2002 to March 2004. Now, let us discuss about hedging exchange risk. Forward rates can be very useful as a tool for hedging exchange risk. The caveat is that a forward contract is highly inflexible because it is a binding contract that the buyer and seller are obligated to execute at the agreed upon rate. Understanding exchange risk is an increasingly worthwhile exercise in a world where the best investment opportunities may lie overseas. For this purpose, now we will take an example with our home currency for a better explanation and understanding of the overall concept. Consider an Indian investor who had the foresight to invest in the Canadian equity market at the beginning of 2012. Total returns from Canada's benchmark S&P TSX equity index from 2012 to August 2016 were let say 106% or about 11.5% annually. Compare that performance with that of the S&P 500, which has provided returns of only, let us assume, 26% over that period or 3.5% annually. Here's the kicker: because currency moves can magnify investment returns, an Indian investor invested in the S&P TSX at the start of 2012 would have had total returns in terms of INR of 208% by August 2016 or 18.4% annually. The Canadian dollar's appreciation against the Indian rupee over that time frame turned healthy returns into spectacular ones. However, it is an altogether different story for Canadian investors invested in the Indian equity market. In this case, the 26% returns provided by the S&P 500 from 2012 to August 2016 would have turned to negative 16% due to the Indian rupee's depreciation against the Canadian dollar. Hedging exchange risk, again with the benefit of hindsight, in this case would have mitigated at least part of that dismal performance. So let us summarize today's session. In today's session, we talked about interest rate parity. Interest rate parity is fundamental knowledge for traders of foreign currencies. In order to fully understand the two kinds of interest rate parity, however, the trader must first grasp the basics of forward exchange rates and hedging strategies. Armed with this knowledge, the forex trader will then be able to use interest rate differentials to his or her advantage. The case of US dollar versus Canadian dollar appreciation and depreciation illustrates how profitable these trades can be given the right circumstances, strategy and knowledge. In today's session, we went through its concept, that is two types, covered interest rate parity and uncovered interest rate parity, and lastly talked about how to hedge the exchange risk. I hope this session would have been useful to you in understanding more about the fundamentals of international financial management better. Thank you.